If you're enjoying this Which podcast, then you might also be interested in listening to other podcasts that we have to offer, like Which Shorts. Which Short is our weekly podcast that brings you a flavour of what the Which magazine has to offer, as well as our dedicated travel, gardening and tech magazines too. Each week we handpick a review, investigation or feature that was printed in one of our magazines and written by one of our award-winning writers. We then bring it to life on the podcast. So, to get a taster of what Which members get in our suite of magazines, be sure to listen to Which Shorts wherever you get your podcasts.
Hello and welcome to the Which Money Shorts podcast. I'm the host of the Which Money podcast, Lucia Ariano, here to bring you a taste of some of the best money advice taken straight from the Which Money magazine. This week we're looking at investment fees and what you can do to minimise the costs and save money. This article was originally written by Sarah Davidson. The expenses involved in investing can seem overwhelming, but getting a grip on fees is an opportunity to boost your portfolio. Every pound you can save can produce several more in future returns that you wouldn't otherwise earn. Firstly, try to prioritise ISAs. Previously, you could only pay into one stocks and shares ISA a year. The rule has now been scrapped, which combined with shrinking tax-free allowances has made ISAs more useful and needed than ever. The annual tax-free dividend allowance has fallen to £500, while the capital gains tax allowance, or CGT, has fallen to £3,000. In an ISA, neither tax applies, nor will you have to declare dividends, interest and profits to HMRC as you would if you held a general investment account. A small number of investment platforms charge more for ISAs than they do for general investment accounts, so weigh this up against the tax and time saved on administration. If you're likely to exceed the £20,000 ISA allowance, you could open a self-invested personal pension. You can pay in up to £60,000 a year or your pre-tax salary, whichever is lower, and benefit from tax relief, free from dividend tax or CGT. As with all types of pension, for every 80p you put in, the government adds 20p if you're a basic tax rate payer and 40p if you pay higher rate income tax. You can access private pensions only when you reach 55 or 57 from 2028. Transferring your ISA to a cheaper provider is one of the few reliable ways to improve returns. But the prospects of navigating bureaucracy and potential market losses means it stays on many investors' rainy day to-do lists, never to be revisited. To get started, you'll need to contact your new provider and provide your details. The process will vary from one platform to another, but many still require you to post printed forms. Check if your current and new providers offer these, as not all do. You can lose money if you sell or buy back into the market at an awkward time in a cash transfer, although it can be faster. While exit fees are largely a thing of the past, you'll still have to pay at Charles Stanley Direct and HSBC. In theory, transfers will take up to 30 days starting from the confirmation of your new provider to your old provider. While most will get done in this time frame, unfortunately we've heard plenty of cases where people's money gets held up. If things go particularly badly and you lose out financially as a result, you can complain to the Financial Ombudsman Service. If you can't face the prospects of a transfer yet, you can now open and pay into more than one stocks and shares ISA each year. This means you won't have to commit to transferring your ISAs across until you've tried the new platform. You could consider an independent financial advisor or an IFA, but it is the most expensive way to get help with your investments, costing up to 3% of the amount you have invested. For that, you get a full assessment of your financial circumstances and goals, plus personalised advice on how to invest your money. Be vigilant when choosing an IFA. Their charges can vary considerably and take a big chunk out of your returns. Some advisors will charge an initial planning fee on top, which can be as much as 5%. Consider what you're getting in return and remember that this is an extra fee on top of fund management charges and platform fees. Some investment platforms offer one-off advice sessions with a fixed fee. However, this is often restricted advice, only looking at that platform's products, not the whole market or focusing only on one area of your finances. If you're unsure about how much risk you want to take or what to invest in, platforms including Interactive Investor, Vanguard, and Wealthify will build a portfolio of funds based on your responses to an online questionnaire about your goals and attitude to risk. They will cost a little more than a DIY platform, but are still far cheaper than IFAs. You're usually unable to change your portfolio yourself and will likely be invested in funds. If you already know how much risk you want to take, many DIY platforms offer a range of ready-made investments. Which recommended providers AJ Bell and Vanguard both have funds investing in a broad range of assets designed for certain levels of risk, with total fees adding up to around 0.5%. Nearly all the big investment platforms and financial advice firms charge an annual management fee, sometimes referred to as an account charge. Some platforms offer free accounts, some charge an annual percentage fee and others charge a flat rate monthly fee. In general, a percentage fee model lends itself to smaller portfolios, while a flat fee model works better for large portfolios. Some platforms cap or lower fees on amounts above a certain level, suiting those with larger investments. In theory, free platforms should suit all parties, but look out for charges such as those to hold investments in an ISA. One-off dealing charges or trading fees are applied by the majority of platforms when you buy and sell shares. Investment trusts and exchange-traded funds, ETFs, with a minority charging for buying traditional funds. If you plan to buy and hold investments for several years, focus on the management charges rather than trading fees, which even at their steepest top out around £12. However, if you plan to trade several times a month, consider a platform with no transaction fees or low price included in a monthly fixed fee such as Interactive Investor. You'll sometimes get lower or even no fees by investing a certain number of times per month, or if you invest a regular amount each month via a direct debit, and reinvesting dividends is also often fee-free. Choose funds carefully because funds and trusts charge a management fee. Fund manager fees across the board have fallen over the past decade, so be sure to compare older funds you hold with newer equivalents. The fund's management style is also crucial. Passive funds track a specific part of the global stock market, either a region such as the UK, US or European companies, or a theme such as emerging markets, clean energy or large cap companies. The fund replicates the relevant index and aims to match its performance by holding all the companies in it. Actively managed funds try to outperform the market by picking and choosing which stocks to hold. They tend to charge more than passive or tracker funds, with fees ranging from 0.05% to over 7% in some cases, which is an annual fee of £20 or £700 for every £10,000 invested. Most investment trusts are actively managed. Passive funds tend to be cheaper, though fees can still differ substantially. The most expensive passive funds can sometimes charge over 100 times more than the cheapest option. For instance, Morningstar data shows the cheapest UK equity tracker funds charge 0.01%, while the most expensive has ongoing charges of over 1% a year. So an investor with £10,000 invested in the most expensive UK stock market tracker pays around £104 in fund fees every year, whereas those invested in the cheapest passive funds pay just £1. The difference can have a dramatic impact on long-term investment returns. An investor with £10,000 in the cheapest fund tracking UK equities would have a portfolio worth £16,273 after 10 years based on a 5% annual investment return. The same amount invested in the most expensive would leave you with £14,746, with more than £1,500 of investment return lost in fees. High returns can make up for high fees, and it might be worth paying them to access more niche regions or markets, or for a fund with a great record of reliably generating income. But if you're comparing two funds tracking the same market with similar historic returns, there is a compelling argument for choosing the cheaper option. thank you to Sarah Davidson for that original article taken from the October edition of the Which Money magazine. If you want to subscribe and get the magazine delivered directly to your door, click the link in the description of today's show. For even more expert money advice, subscribe to our free newsletter and don't forget to tune into our weekly money podcast with new episodes every Friday. This episode was produced and edited by Romana Yasid. Thank you for listening and I'll see you next time.
Next time you need to get work done on your home, or your car, or your garden, make sure you choose a trader you can trust. And don't just choose any trader, choose a Which trusted trader. Our trading standards professionals only endorse traders who've passed our rigorous assessment that includes credit reports, customer satisfaction surveys, reference checks, and interviews. When we say a trader's good enough to display our Which trusted trader logo, you can trust us. But don't take our word for it. Search Which Trusted Traders online to see our directory of around 4,000 traders. Every customer review you read there is verified genuine by our moderators, so you can choose with confidence. To find a local trader you can trust, search Which Trusted Traders or go to which.co.uk/traders. That's which.co.uk/traders. Everybody needs a trader they can trust.